Hello, Marc Ostwald from ADM Investor Services International, with some start of year thoughts about where markets find themselves and some perspectives on risk reward. So my first chart today is, well, it's a table in fact, is the market implied policy rates. And as one can see, for much of the developed world, what we're looking at is a very flat profile for interest rates as far as the eye can see, as far as one can realistically forecast, which is a 3-year perspective, and many things may change given all the uncertainty. I think the notable part of this is the exceptions. One, that we're looking for policy tightening in China of about 65 basis points by the end of the year. We're also looking at tightening policy in places like Brazil, Chile, the Czech Republic and Norway. So it's not quite universal, but I think this is one of the big threats to financial markets, that we get an adjustment either due to better than expected growth, higher than expected and more persistent inflation. There's all sorts of things which could impact this, but the assumption of flat rates for 3 years, while promised by central banks, is not necessarily one should say is basically a baked in the cake assumption. So where do we stand in terms of volatility? Well, I think the interesting thing on the second chart, on the VIX volatility chart, is a very simple observation that it's low, but we've certainly not got back into that 12 to 20 range that was there up until the end of 2019, and indeed basically up until the outbreak of COVID. And that's it's something which I think will pick up this year, and I'll come back to that in a moment. Next one is the US Treasury Move Volatility Index, the third chart. Again, this is extraordinarily low. In fact, it's actually lower than it has been for quite some time. And it basically is low simply because of that assumption about interest rates. However, with Mr. Biden now having control of Congress, the questions will start to arise about whether the expected boost to fiscal stimulus and large amount of spending and perhaps some tax increases will result in a rather steeper US yield curve, and whether the Fed will actually respond to that. We shall have to see. My fourth chart really is basically, it's a familiar one. It's US investment grade credit spreads versus high yield credit spreads. And it shows that basically we are at the very low or the very tightest levels of spreads. And it's well worth thinking about this from the context, and this also applies to things like the VIX and anything else one might be thinking about in terms of equity markets, that we are at levels which aren't the same sort of risk reward levels which were there after the big sell-off that we had in February, March last year, i.e. in April, May. We are at very tight levels of spreads. We are at very high levels of equity valuations. And therefore, the risk reward skew is notably different to where we were this time last year. And that, to my way of thinking, plays into the scope for a higher level of volatility. My fifth chart today is the JP Morgan emerging market bond spreads. This is obviously an area which people are very keen to get involved with, both internationally, i.e. foreign currency bonds, which this is a representative of. There is some scope for it to tighten in a little bit more, but it's certainly quite highly valued. I think basically people need to look at this on a much more regional level than just a wholesale emerging markets are good. Asia seems to be the area with the strongest growth prospects, and therefore weightings probably will need to be going in that direction. My sixth chart is finally the US dollar versus the Chinese yuan. China, obviously the economy which is recovering most strongly, but obviously faces a lot of adversity in terms of the tensions with the US and indeed with a number of other currencies. Nevertheless, as much as the Chinese yuan has appreciated sharply to start at the beginning of the year, one can see on this 5-year chart or 6-year chart that there is still some scope for it to improve. So some basic thoughts there on risk reward for 2021.